Inflation, another flip lesson from Mr. Meyer. I will talk to you today about the measurement of inflation, mainly through this indicator called the Consumer Price Index, CPI, the recent performance, types, there's three types of inflation, the causes of inflation, the impacts of inflation, and government management of the problem called inflation. When we talk about the measurement, we talk about the Consumer Price Index, the CPI. It's expressed as a percentage. This is the way that we look at the measurement. It's a simple percentage change formula. So we take the CPI from the current year, take away the CPI of the previous year, and divide it by the previous year. Now the Consumer Price Index is just a random number that statisticians use, but the important thing is to note the increase in change, percentage change, in the basket of prices of goods that the Australian Bureau of Statistics has put forward. I'll show you what that contains. So here is a snapshot of the types of things that the ABS follow the prices on: footwear, accessories, rents, furnishings, of course there's food, entertainment, and so on. This is just a snapshot. So they're the sorts of things that they track the prices on from one 3-month period to the next. Now, when we talk about the CPI, we also must talk about the section or the categories of the types of things that they cover, and also the weighting it has under the CPI. You can see that food has the second biggest weighting. Housing it has got the biggest weighting in terms of either paying rent or paying your mortgage repayment every week. Recreation is quite high, as is transport. So these are basket of goods, and there's specific examples of what is in those particular baskets, and these prices are tracked, crunched together into one measure called the CPI. Let's have a look at underlying inflation. The inflation rate that we normally hear about is called the headline inflation. Now, sometimes there's some volatile one-time price movements that can give an uncertain or unclear picture of where inflation's headed. For example, when we had a drought in Queensland, or there was a whole lot of storms in Queensland, which meant that the bananas and other tropical fruits, the prices of those rose through the roof, which contributed unfavourably to the headline inflation rate. Right. Now, when we talk about the underlying inflation rate, those sort of one-off or volatile price movements are taken out, which then gives us a more clear picture of where inflation's going. Now here are two graphs which I'm going to show you in a moment where I got them from. They're both from the Reserve Bank of Australia, and when we look at inflation, we always have to track that in the context of the business cycle. Here you can see inflation in GDP growth going down, and in this instance, when we look at the Consumer Price Index, the Consumer Price Inflation, we see that the index is going up at this point. Now the data that I will be looking at is from the Reserve Bank, Australian Bureau of Statistics, and Trading Economics. First up, the Reserve Bank of Australia. This is the main site, the first page, and you notice that the cash rate, which is the interest rate, is the first thing that is posted up there, but the inflation rate is the most important thing that the Reserve Bank manages and part of their economic management of the policy. So that's always up there. What I'm interested in, I look at the chart pack. Once I'm in the chart pack, I derive this particular graph. You can see that currently the the inflation rate is just above 2%. It's within the accepted band of between 2 and 3%. And if you have a look at this, the performance has largely been successful in that the Reserve Bank has kept inflation within the bands of 2 to 3%. Another site worth looking at are the key economic indicators from the Australian Bureau of Statistics, and under the prices you can see here, that's the Consumer Price Index. Currently it's 102. Another good site to look at is Australian Bureau of Statistics, the key economic indicators. When I go down to the prices, I will find that the Consumer Price Index, they've reset it here. As you can see that the index they set last year at 100. It's gone now up to 102. Importantly, these two figures here tell us a bit of a story. If you look here at previous change, it's gone up by 0.2%. In the last year, it's gone up by 2.2%. So as I said before, that's within the accepted price range. And it's only gone up by 0.2%. And if that is annualised, i.e. if we multiply that by 4, because there's 4 quarters in a year, you can see that the rate of inflation, the increase, is starting to slow down, and that also tells us something about the business cycle. Lastly, I can show you another site, the Trading Economics site, looking at the core inflation rate. Okay, and you can see that this tracks the quarterly movements over a number of years since about 2007. Again, I like to use this trend, and when that changes, you can see that there's really, over the period of time, it's more or less kept constant at about 0.65 per quarter. Remember, that's per quarter, so if that's annualised times 4, you're going to get around the 2.5% mark, and that's where the Reserve Bank wants to be. It's important looking at the recent data. Now let's keep moving. First of all, I'd like you to go to your textbooks, and in section 9.2, questions 1 and 2, and 9.3, question 1. Please do those, check your understanding before you move on. There's 3 different types of inflation: cost push, demand pull, imported inflation. Let's look at demand pull first. That's to do with the consumer side. So when aggregate demand is bigger than aggregate supply, we'll have increased economic activity. It's almost like an auction where people with more money will be willing to spend more and buy more things. It also happens when the productive capacities, particularly the Australian economy, is exceeded, so it just can't keep up. If there's a supply shortage, then producers will see that and charge higher prices. As I mentioned, that the consumers with extra money will bid the prices up, and that can be explained in looking at this graph here. Right? So they've basically got more money. This is collectively the whole economy. There's a new set of conditions for demand, increased income, which means we'll have a higher price, and also the output has increased. The next one is cost push inflation, and this is taken from a point of view of a supplier. So we're talking about costs of production. Cost of production, labour, cost of capital, land resources, and so on. Usually what happens is that the businesses will pass on those costs to consumers. So if there's an increased wage demand, that will be mostly passed on if it's practical to do so, and that's usually dependent upon the competition that the particular business is operating in. As I mentioned, the major source of price increases tend to be oil and wages. Looking at a aggregate supply, aggregate demand curve, if there are, in this case, we have increased costs, for example, an increase in wage, or if the major oil price has gone up, you can see here that we're going to have new conditions of supply, aggregate supply, which means that things are going to be offered at a lower price, I beg your pardon, at a higher price, at a lower output. The last one we talk about imported inflation, and that is reflected by international transactions. When we have by rising imports, happens when the dollar depreciates. Right? Currently, we're in a situation where our dollar is really strong. Our imported products are therefore cheaper, and therefore have the opposite effect occurring in Australia. We have decreased inflation, or indeed deflation. So when it goes the opposite way, when our dollar depreciates, it becomes more expensive for us to buy imported products, and that in itself leads to imported inflation. I'd like you to stop section 9.4 questions 2 and 3 to check your understanding of what I've just been talking about. Let's look at the impacts of high inflation. It creates uncertainty amongst businesses. If prices are rising, businesses are making big investment decisions for what capital equipment to buy. Sometimes we're talking about hundreds of thousands, millions of dollars, and also may take years to get the money back and generate enough cash flow to make it worthwhile. If inflation is around, high inflation is around, it makes estimating those future benefits difficult, and we don't know what the value of our spent dollar in today's terms will be in tomorrow's terms. So that creates uncertainty amongst businesses. And with that uncertainty, it distorts economic decision making in relation to spending and saving. So from a business perspective, I may not make that investment decision. I might make another decision. And if the business is not investing, it doesn't add to the productive capacity, it doesn't add to the long-term viability and level of production that the economy is capable of. From a personal perspective, because if I have cash and it depreciates in value, the purchasing power of my dollar goes down, I may decide to invest in an asset which maintains that particular value. For example, I might buy some gold, I might buy shares or property, for example. Right? And it also has an impact upon my saving. I'm not going to keep my money in the bank. I'm going to put it somewhere where I can maintain the value in my wealth. It also can lead to a wages spiral. So as I mentioned before, if we have cost push inflation, the businesses pass on any wages costs or any other costs that they've been confronted with, and then unions, when they come to demanding more wages or comes to the next enterprise bargaining agreement, they will say, look, prices have gone up, we need more wages in order to cover it. And this can lead to a dangerous wages spiral. And it's very important in Australia that we keep that under control and have a sustainable wage increase so we can keep inflation under control. What also happens when we've got levels of high inflation, because the people with money are able to protect it, they are able to maintain the value, and the people with savings or less money, that means that they will have a lower level of wealth, which means the rich get richer and the poor basically stay where they are, and the gap between the rich and the poor widens. Our exported products, they become less competitive. It means they become more costly for overseas customers to buy. Therefore, our products and services become less competitive. Therefore, we sell less, obviously. And what it also means is that in order to combat the high inflation, the Reserve Bank will increase interest rates, which will lead to people wanting to save more and spend and borrow less. You need to remember that inflation is inversely related to unemployment. It's best illustrated by this graph called a Phillips curve. So when we have a low unemployment rate, we have a high inflation rate. Okay? When we have a low inflation rate, we have a higher unemployment rate. So you can have either one or the other. They're inversely related. Again, I'd like you to stop. Section 9.5, questions 1 and 2, please, before you move on. Lastly, we're going to talk about government management of the economy. The first and most obvious one is monetary policy to change the level of interest rates. This is administered by the Reserve Bank. We'll talk about monetary policy and the mechanics later, but what I want you to understand that when inflation is high, that means a lot of spending is going on in the economy. What the Reserve Bank does is increases interest rates to stop people spending as much and borrowing as much, which gives them an incentive to start saving and to spend as well. Fiscal policy is what the government is responsible for, and they've got two levers. When there's high levels of inflation, lots of spending, why don't we increase taxes, which is a leakage, right? It takes money out of the system. It decreases the level of government, of economic activity. And what they also can do in this instance is to decrease the level of government spending, less stimulus, which means there's less of an injection, and that again hopefully brings the economic cycle under control. Other things that the government can do are what we call microeconomic policies. Remember, when we look at the microeconomic instances, we are talking about small parts of the economy, an industry or a certain section of the whole economy. Again, I'd like you to stop. I want you to go to the end of the chapter and look at the chapter review questions 9 and 10. Okay, I hope that's been useful to you. Now it's over to you. There'll be plenty of exercises that I will give you and case studies, but this is a very important economic problem that we need to know how it operates and how it is treated by government. So hopefully that's been a good background session for you. Thanks for listening.